Hey everyone, welcome to the KE Report in a daily editorial on Monday, December 8th, chatting with Craig Hemke. Craig is the founder and editor of TF Metals Report. We'll post a link in the show notes so you can visit Craig's site and keep up to date on what he is writing about in the metals sector. Craig, we'll start with silver. Boy, oh boy, we talked a whole lot about silver last week, really over the last couple weeks. Is silver, after breaking $50, consolidating for a little bit around that level, and then really skyrocketing just in the last couple weeks, maybe even just a week, where it's shooting up close to $60 an ounce. It's a little bit off today, but overall, boy, oh boy, we're seeing $1 to $2 moves in silver day after day, mostly to the upside. Craig, what do you think about what we're seeing in silver, and maybe even tying in, if you care at all, about that gold silver ratio that it's sure come down quite a bit from being well over 100 earlier this year?
It has been quite a run, no doubt about that. And what did we finish up last year? About 31, I think, maybe in silver. I remember we were talking at the end of last year about could it post a new all-time high annual close, and what would that mean for the year ahead? And I mean, if it had posted an all-time high annual close last year, we'd be like, see, what happened next? And it did it regardless. It has been a heck of a year, outperforming gold as well, even though what's really remarkable to me is that gold was up 25% last year and has then tagged that on top of that this year, another 60%, which has never been seen before. That's nothing we've ever, usually in the past, if we've had a 25% year, gold falls or goes sideways the next year. So it certainly has been a heck of a year. This latest move in silver certainly catching some people off guard. And I'm curious to see what happens next. The price had gone up to 54 back on whatever that was, October the 16th, at least the COMEX price, fell backwards to 48, went back up to 54, and kind of established itself in a range. And then on Black Friday, as we call it, the day after American Thanksgiving, 5, 6 trading days ago, into what is typically a very light volume, kind of quiet, kind of bullishly bent Santa Claus rally day anyway. Silver rallied, broke through those highs, which then kind of set off a buying frenzy of CTAs rushing in, chasing the momentum, but also shorts that were being covered, with automatic buy stops. And people said, boy, if it breaks out, I better have a stop order in. And so you had this huge run of $3.50 or whatever on that Friday, and then it followed up last week. So now we're in this kind of banging around between maybe 57 and 59. And I'd be curious to see what happens next. The Fed meeting this week is going to be probably the pivotal thing that will push us one way or the other, at least in the short term.
Well, Craig, just following up a little bit on the price action in silver, as you noted, it broke above that, what people were considering a double top at 54. So that was bullish on that Black Friday. I think it got up in the 57s. It closed last week above 59 for the first time on a weekly. So 2 weeks in a row, the highest weekly closes of all time. But it is getting pretty stretched above its 50-day moving average. It's way above the 200-day. And so it's pretty stretched on the price move. It's also pretty stretched on the RSI. It's up in the 80s. And then when you look at the amount that has moved up so fast, do you think it's in danger of topping out here? Or is this the proverbial silver squeeze in motion where there's so many shorts that are covering that it could just keep ratcheting higher?
Well, we don't know and won't know regarding the market dynamics for another 6, 8 weeks before the CFTC finally catches up and we start getting regular commitment of traders reports again. So it's hard to say. I mean, we kind of, I try to track the open interest on a daily basis, and you can mostly equate, if say, for example, price is rallying sharply while open interest is falling, that's typically a sign of shorts being covered, right? And open interest being closed out. But it's hard to extrapolate that day after day after day and say, okay, so this has been the general trend. But I do think, again, I remember talking about this a lot earlier this year when gold was rolling and silver wasn't. We talked about silver in the terms of creating its own momentum and its own inertia. That once it gets rolling and it goes up $2 or $3, 10%, and that gets some attention, and people are like, oh boy, silver's breaking out, and then more people get on, and it gets more momentum to the upside. And that's kind of what it's been doing. So the potential is there in what is typically a pretty strong seasonal period that begins about the middle of this month and runs through January and early February. I mean, the potential is there for it to break out again. I mean, not that it's been trading sideways for 4 days, so it's not like, you know, it's putting in some new range. The potential is there for it to squeeze even higher. Let's just put it that way, or rally even farther. Probably a big driver that might be what gold does. Gold kind of has some resistance at about 4250 to 4300. If gold gets through there, it then probably goes back to its highs in from early October. And if it begins to break out and does another one of these 20% rallies like it's been doing for the last year and a half, yeah, I can't imagine silver's not going to tag along.
Craig, one thing we always hear from the silver space is it's industrial metal as well. I still believe that the investment demand driven from the precious metals aspect of silver really is what's driving prices, especially when we see these sort of price spikes. But how do you balance out maybe the industrial side of things? Because it's not like, or I didn't read anything over the last couple of weeks that showed something major that changed on the industrial side that could have caused this price spike. But we constantly hear there's a shortage of silver out there. So how do you balance out when you're simply looking at it from the price and investment angle, what the industrial side is doing here?
Well, and you know, I relate that to copper too, Corey. You know, copper, not on the COMEX, the copper price isn't at all-time highs, but the LME price, the copper in London, is making new all-time highs. And is that a shortage of the? I mean, yeah, I mean, we know the demand side of copper, just like the demand side of silver continues to increase, is it actually being reflective as, you know, as a shortage of physical metal and impacting price? You know, I guess I'm still more apt to look at rallies that are, I don't know, I don't want to say they're all futures based, but it is the trading of the derivatives that certainly seems to hold more sway than the trading of the physical still here in late 2025. And these, you know, when anything breaks out and moves, keeps moving new all-time highs, whether it's, you know, a stock like Nvidia, you know, or any of the Mag 6 or 7, or whether it's copper or whether it's silver, there's just this kind of follow along, not necessarily a FOMO trade, but it's just like I'm buying it because it's moving up, and it's moving up because people are buying it. And that seems to be, to me at least, that seems to be a bigger driver of the current action in silver. I mean, there's a collection of fundamentals underlying all this, just like central bank demand underpins gold and kind of keeps it from selling off sharply. So, I mean, there are definitely the supply demand physical fundamentals underpin these markets. But man, a lot of these short term moves are just big, huge, high volume surges of futures trading. And to me, that's what the primary driver of silver, even you know, in the current time.
Well, if we're talking about the industrial demand of these base metals and we're looking at silver's industrial component and copper, you know, you look at something like copper, it's called Dr. Copper for a reason because it's in everything, especially wiring and pipes and different things for building new construction. Obviously, the AI data center narrative has taken over, but copper underneath the surface is still needed as the whole world continues to electrify. So it's a big market. It's often seen as an indicator of economic health. Well, copper closed November at an all-time high. COPEX, the copper producers, closed November at an all-time high. Copper closed last week at a pretty big level. It may not be the highest level in the futures, but it's up there. We're in the 540s as we speak today. What does that mean about the health of the economy? Does that mean the economy is doing okay, or people wouldn't be bidding it up, or have the futures prices diverged from the economy?
Yeah, I mean that's an interesting question that I obviously we can't know the answer to. In the past, like you said, a whole bunch of economic growth, new buildings, you know, and anything that uses electricity, all that kind of stuff. You look at that, okay, so obviously there's a lot of demand for copper, and that's pushing the price higher. Fundamentally, that makes sense. At the present, I'm sure there's some of that, right? I mean, you read some of the statistics out of China and copper demand, and we know where demand is headed in the years to come. So I certainly think that's a big part of it. But I don't know, you know, because again, as I was just saying, there's so much investment demand, and maybe that's not even the right term. There's so much trading demand when something is moving up that it kind of gets away from the fundamentals. So I'm not really sure that we can, you know, directly go one to one at this point and say, well, copper's rolling, so therefore the global economy is rolling. I mean, it's probably true to some extent, and by a lot of traditional measures, at least the U.S. economy seems to be at least hanging in there from a manufacturing standpoint and construction standpoint. But I'm not sure if we can, draw the, one-to-one cause and effect, maybe with copper as Dr. Copper and, showing economic growth as maybe we used to.
Yeah, on that topic, the other market that we look at for economic growth or stability is also the oil market, right? And oil's going in the opposite direction that copper is. And quite frankly, copper is becoming much more higher priced than oil in even a multi or a decade, multi-decade long chart. So, yeah, I don't know what it all means, but we do keep hearing about copper shortages. And quite frankly, there's a lot more issues around copper mining than oil production. Oil production can come online way quicker than copper production can. It's what we keep reading about. All right, well, then, Craig, the big story this week is going to be the Fed. I think we're all in alignment that the Fed is going to be cutting rates, or at least that's the way the market's positioned. And it just seems like the Fed is going to sneak in one more cut before the end of the year. And then who knows about next year? In all fairness, I think everyone's been pretty bad at predicting what the Fed is going to do with their rate cuts in one or two meetings, let alone the whole year. But how are you looking at this Fed meeting coming up this week?
Well, there's a couple things there. One, every meeting on the quarter, March, June, September, and December, comes with what they call a summary of economic projections. And that gives you what it is. It's a summary of what all these Fed goons are thinking, collectively about what inflation is going to, the unemployment rate, how many cuts are coming, that sort of thing. So we'll get that. The recent trend, although it was thrown off at the October meeting, is a lot of times what I call the Fed lines that are released at 2 o'clock Eastern creates one market move. And then once Jerry starts to speak at 2:30 Eastern, it goes the other direction. Now, the last time back in October, the dollar rallied and the metals and the markets fell. And then Jerry started talking and the dollar rallied further and the metals and markets fell further because he muttered about 5 minutes into his press conference that a cut in December was not, in his words, a foregone conclusion. At one point, I think the odds of a rate cut at this meeting coming up in this week were down to like 38, 39%. Well, now it's up to like 88, 89%. So I suppose, there's room in there, if they end up not cutting. Okay, well, that market, we tell you there's a 1 in 10 chance that's going to happen. Probably more likely is the analysis that will follow that says it's a hawkish cut, which I don't even know what that means. It's like jumbo shrimp or, military intelligence or something like that, right? A hawkish cut. But that's probably the spin that's going to come out of it. And that might be, if anyone's looking to trade, looking for an entry point, looking for the low of the week, that might be coming. Somebody between like 2 and 2:30, or even after Jerry starts speaking at 2:30 on Wednesday. And then maybe we get a rally after that. Because at the end of the day, and this is what I try to remind people with the foregone conclusion comment last time, is he's gone. I mean, he's going to have an impact for, one more major Fed meeting, which is the one in March. Okay, 3 more meetings until he's done. Trump has made it pretty clear that he's already made a decision. Polymarkets seem to think it's going to be this guy Hassett, who's one of his economic advisors. If that's the case, and if he does become, the head of the Fed for the next 4 years, he's just a yes man. And if Trump wants 200 basis points of cuts next year, this guy's going to try to lead the Fed into doing that. And so Powell can sit there and talk about, hawkish cut and all this kind of stuff. And that's going to impact, and the algos are going to trade off that. But in the bigger picture, as we go into 2026, all that stuff, whatever Powell says, whatever the SEP says, that summary of economic projections, it's all up in the air because whoever Trump nominates, whoever gets put in there is going to run things a little bit differently the way Powell has.
Well, Craig, let's play that out. Let's say that Powell, because a lot of people are saying he's going to be a lame duck for the rest of the portion of his chairship, and then you're going to move into the yes man. So whether that's Hassett or somebody else, let's just assume that they go cut crazy next year. What does that do to the markets? Have the markets already priced that in? What does that do to the precious metals if there are a lot of cuts next year?
Well, we'll see. I think on a bigger picture, the way I've been reading the tea leaves all year, and to me, it explains some of the 60% rally in gold this year, which is so unusual after what happened last year. I think there are institutions and hedge funds and the like that are front running all of this that's coming next year now. So maybe, yeah, to your point, Shad, maybe we're paying forward some of next year's gains and cooking it into this year, or you go 60% this year and then 0% next year for an average 2 years of 30. You know what I mean? So there definitely could be some of that. But what I've been anticipating all year is, if we get back to cutting on the short end like we did in the fall of 2024, and the bond market sells off like it did in the fall of 2024, and all of a sudden we're looking at 5% on the 10-year again, while, Hassett or whoever is trying to take Fed funds down to 2. I don't think that dog's going to hunt. And I think Bessent has been warning us about this when he talks about the operations of Fed and Treasury working more hand in glove together. There are a lot of attempts at managing yield curves in sovereign nations around the globe. And I think that's the direction that the Fed is headed. And at the end of the day, that if they do start to either overtly or covertly institute some form of yield curve control, that institutionalizes sharply negative real interest rates. And that, at the end of the day, has always been one of the most bullish factors for the precious metals whenever we've seen it. So anyway, that's a long kind of rambling answer trying to tie all that together, but that's how I think it's all going to play out. And again, to your point, maybe some of those gains for next year are already being priced in this year. That's certainly a possibility.
So the here and now, Craig, if we talk about the rate markets, I find it interesting. You look at, say, 5-year, 3-year rates. Actually, you go back. If we're looking at 3 or 5-year rates compared to 10-year, compared to 30-year, we can make the argument that all are pretty much within trading ranges going back to 2023. However, the long end bonds, the 30-year, very close to the high part of its range. The shorter year bonds, very close to the bottom part of that range, and the 10-year right in the middle. So should we be watching one certain market over the other to get a handle on what is, I guess, going to happen? Not so much at the Fed, but what will carry over to more markets, whether we're talking metals or general stock markets?
Yeah, I think you split the difference, and it is what I've always seen referred to as the foundation of everything, and that's the 10-year note. Not so much the long bond, and not so much a 2-year note, or even down into T-bills and what those rates are. I think it's a 10-year note. I think that's the one that a lot of mortgages are keyed off of, and throughout the U.S. economy and really the world as a benchmark investment for central banks. And so, what the Fed and the Treasury can't have is a buyer strike. I mean, already in the first month of the new fiscal year, the U.S. already run a $287 billion deficit for just the month of October, already 10% ahead of last year, even with the tariffs. Oh, there's another thing that's hanging out there we didn't even talk about. What if it comes out that the Supreme Court rules that Trump did not have the ability to institute all these tariffs and demands that the U.S. pay them all back? What they've collected so far, like $200 billion. Where's that money going to come from? More borrowing. So they cannot afford a buyer strike. And why would there be buyer strike? Well, because, I'm not taking 4% anymore for a 10-year when inflation and everything else is going on. And that leads to this yield curve control to try to get buyers to have the faith to buy the treasuries and fund these ongoing debt needs. Anyway, it's all big picture kind of stuff. And ultimately, that's all the big picture stuff that has had me buying gold since 2009, and why I kept buying it all the way through 2013, 14, and 15, and why I continue to buy it today, because as we always say, the math is the math, and that's ultimately what's going to be the downfall of all of this.
Well, Craig, let's move from big picture to very small picture, the month of December. We are still right in the heart of what is normally tax loss selling season. Some even call it tax loss silly selling season, because some of the discounts that we see in a number of equities, especially in the commodity space, get to ridiculous levels. But this year, if you're in gold stocks or silver stocks or copper stocks, there's really not a whole lot of losses to cash in on, unless you're maybe in the explorers. Do you expect that to change the seasonality that we normally see, where people sell or reposition between U.S. Thanksgiving and Christmas, and then gear up the new year and the Q1 run, with January and February being a seasonally strong time for the precious metals? Has the seasonality changed at all in your view?
Yeah, I was thinking that earlier when we were talking about, because I've been mentioning that seasonality so frequently over the last couple of weeks. How much of the generally positive seasonality is due to the investors swooping in and picking up bargains that are brought about by all of this tax loss selling? And if there's not a lot of tax loss selling this year, you don't get, you don't have a reason to swoop in and buy things up. So that's part of it. Because obviously, I mean, there are certain explorers that maybe haven't done well, or unless you waited until October the 16th or the week before to start buying the metals or the shares, you don't have a lot of losses that you want to use or harvest or whatever the term of financial advisors is that they use. So maybe we don't have that the same as we have in the past. Though, I'm going to hang my hat on this miners, at least relative to where they were at this point last quarter, are undervalued again versus 90 days ago, because we've now got 3 weeks to go in the fourth. 3 weeks to go in the fourth quarter. I mean, most of the production has been sold already for this quarter, and the average price per gold through this quarter is north of $4,100. The average price for silver is now north of 50 versus about 35.50 and 39 in the third quarter. So you look at that and you see these shares, which are down again today, and it's just, they would seem to be poised to rally. Again, not for the same seasonal reasons as in the past, but poised to rally just in anticipation of what, again, will be just fantastic earnings for the fourth quarter.
Yeah, well, we've talked a whole lot about what earnings could do, and honestly, it just kind of seems like most earnings reports have almost been non-events, but we've seen huge moves before and after those earnings reports, more on the back of what the metals price is doing and the sentiment in the metals sector. We all know how quickly people can come into the sector. They can also leave the sector really quickly, and a lot of the technicians that we've talked to recently, they were very much invested in the sector. Some have come back into silver, especially. Many are still waiting for gold and that other kind of next leg higher. So that all plays into, I think, more of the sentiment and more of the direction on that, Craig. So that also needs to be considered when we're talking earnings.
Oh, for sure. And you mentioned the energy price too. I mean, a lot of the margins have been kept in check this year with falling energy prices. And so if that begins to turn around, which we haven't really seen anything yet, but if that begins to turn around, that puts some margin pressure, right? So we'll see. But to me, it just seems like this is another up leg that's waiting to happen. And we'll just see if it doesn't begin here sometime soon, maybe at least right after we get done with the Fed this week.
Yeah, let's just hope that gold goes back to all-time highs. That's one of the major drivers that we can hope for here. Silver's doing its job, and if gold moves back to all-time highs, it puts a totally different narrative on this sector, as we've seen for the last couple of years now. Is all we've been talking about is all-time highs in the gold sector, and stocks really starting to wake up this year. All right, Craig, we'll wrap it up here. Again, Craig Hemke, founder and editor of TF Metals Report. Click that link in the show notes to keep up to speed with Craig. Craig, thanks for your chatting today. Have a great rest of your week.
You too, man.